Hello everybody, welcome back to another valuation investing video. And today in this video, I'm going to be going into 3 small cap stocks that I believe could potentially 10x your investment. So with that being said, these stocks, all of them are under a $5 billion market cap. You may not necessarily consider them small cap stocks, but they're pretty small cap stocks. And I believe these companies definitely have the potential to make you huge returns, and they're very good fundamentally wise. So with that being said, let's get into these 3 companies and let's get right into the video. So the first small cap stock that I believe could be a great investment is Phototronics. Taking a look at Phototronics here, looking at the stock, we can see the stock price is up 132% over the past 5 years, but year to date it's almost break even, so the stock hasn't done much in the past year to date. As we can see, the market cap 1.42 billion, so I personally believe that's a small cap stock. Some people may say that's a medium cap stock. I think this is more of a small cap stock. So with that being said, looking at Phototronics here, let's go over to what Phototronics does, because I highly doubt any of you have heard of Phototronics unless you have, but it's a very small company. And Phototronics is a leading worldwide manufacturer of photo masks, which are essential components in the fabrication of integrated circuits, which is semiconductors, and flat panel displays. So Phototronics essentially plays a critical role in the electronic supply chain by where they manufacture these photo masks, and these photo masks basically are stencils for other semiconductor companies to laser in the basically pattern onto a wafer for the chips to be more efficient. And as we can see, the products they make is for both integrated circuits, which go into microchips for devices like smartphones and computers, and flat panel displays. So with that being said, also looking at the key customers here, some examples of their key customers is the United Microelectronics Corporation, which is a major semiconductor foundry. Also, we have Samsung, so that's another major company. And then we also have Semiconductor Manufacturing International Corporation, a leading semiconductor foundry in China. And taking a look here, capitalizing on the node migration, this is the key way for them to be able to grow in the future. If they can capitalize on this, the shift in semiconductor manufacturing to smaller, more complex features is going to be a primary growth driver for this company, because as more chips have to be created for AI, these chips have to get even more efficient and smaller to be able to withstand the power AI is generating. So with that being said, they have to be able to keep up with this with higher value masks. The photomasks for advanced nodes are significantly more complex and command higher average selling prices. So if they're able to invest in these tools, that could really help their growth in the future for these stencils. Also, the next gen applications, advanced chips are required for mega trends like AI, like I said, and by supporting the advanced manufacturers, Phototronics secures its position in the fastest growing end markets. Number 2 is the geographic expansion and regionalization. The U.S. capacity expansion, they're strategically investing to expand their capacity in the U.S. Also, they're trying to deepen their presence in Asia. So taking a look at market-io, if you want to go check out the website, just click the link in the description. You can get a 7-day free trial. If we take a look here, we can take a look at the hedge fund and institutions. 56% are bullish on this company. And if we take a look at the valuation here, this value calculator does think that this company is 51% undervalued. So with that being said, let's take a deeper look into the fundamentals of the company here on my valuation investing website. So if you want to go check it out, it's called valuationinvesting.money. You can get a 7-day free trial, and then it's $8 per month if you want to go check it out. If not, that's all good. But let's get into Phototronics here. Like we said, market cap of 1.4 billion. Look at the PE ratio. This is insanely low at 13. That means you're paying $13 for $1 of earnings per share today, and the future PE ratio is even lower at 10. So you're paying a very cheap valuation for this company compared to the market. Also, the free cash flow yield at 4% is very good too. And another really good thing I like about this company, looking at the net cash, they have $575 million of net cash. They have basically no debt, and compare that to the market cap. their market cap's only 3 times the amount of cash they have. That is very interesting. Also, the 7-step stock analysis, it gives us a 5 out of the 7 key metrics here. As we can see, the forward P ratio, very good, like I said. Return on invested capital is pretty good. The growth numbers are pretty decent. The only thing that's bad here is the shares outstanding are increasing, and then future revenue growth isn't supposed to be that good in the next year or so, but that could be wrong. I honestly don't think that's accurate. So with that being said, if we go over to my intrinsic value calculator here, they've been growing at about 8% each year, but I do think potentially that this company could grow around mid to high single digits for the future. So let's just do a bear case of 4%. Let's do base case 7 like it is here. And then let's do a bullish case of 10%. Now for the future profit margin, their profit margin's at 12%. I think this company could stay right around this profit margin. So let's do 10, 12, and then 14, because I just think it's not going to change that much in the future as a result, because I don't think the profit margin will change much in the future in regards of the profitability. And now for the future PE ratio, for a company growing at 4%, they deserve probably a 13 PE ratio. Base case, I'm going to do a 17 PE ratio. Then bullish case, I'm going to put a 21 PE ratio. For the shares outstanding, let's say they increase 2%, base case 1%, bullish case 0%. Now, with my intrinsic value calculator here, we get an annual return of about 10% on the base case, and I honestly believe this could be very conservative numbers. With a 7% growth rate, say they start to grow 12% each year, then we could get a 15% return on our investment. So I honestly think this company could definitely outperform the market, and that's why I think this small cap stock looks pretty interesting. And also keep in mind, this does not take into account the amount of cash, so this return could be a lot higher because of the amount of cash they have compared to their market cap. So keep in mind when we do these value calculations, it does not take into account the balance sheet in regards to cash and debt. So with the amount of cash this company has, this could actually be a much larger return. Now the next company I'm going to be looking at is going to be called Catalyst Pharmaceuticals. Taking a look at the stock here, the stock over the past 5 years is up a whopping 550%, but over the past year, it really hasn't done much. So this stock really hasn't moved a lot, a market cap of $2.5 billion. So this company is a bit larger than Phototronics, but I still think this is a good company to look at, even though it's not as small, even though the video is 3 small cap stocks. I still think that this company is a very interesting company, because taking a look here at Catalyst Pharmaceuticals, Catalyst Pharmaceuticals is a commercial stage biopharmaceutical company focused on in-licensing, developing, and commercializing novel medicines for patients living with rare and difficult to treat diseases. So this company is more on focused in a niche area of pharmaceuticals, but I honestly think that this could give more potential for growth in the future. And their main product is called Firdapse tablets, which for the treatment of Lambert-Eaton myasthenic syndrome, hopefully I'm saying that right, in which in adults in patients age 6 and older, which LEMS is a rare autoimmune neuromuscular disorder that causes muscle weaknesses. Also, they have another oral suspension called Agamree, hopefully I'm saying that right once again, indicated for the treatment of Duchenne muscular dystrophy, so hopefully I'm saying that right. And this is a novel corticosteroid treatment. Another treatment they have is Fycompa, which is for epilepsy, so that could be another interesting one. But let's take a look at the main disease that they're focused on, which is, like I said, Lambert-Eaton myasthenic syndrome. As we can see here, this is a very rare disease, like they said they focus on. Only 2.8 to 3.4 per million people in the world probably have it, and there's only around 400 known cases in the US. So this is a very, very rare disease, but this is the only company that makes it. So with these niche monopolistic companies, this could actually potentially help them, because this is the only company people can go to for these treatments. And the thing that really interests me is that there could be 3,600 affected individuals, but only 400 known cases. So if that's the case, that could be a huge jump in their earnings and revenue if these people actually get treated correctly for this with Catalyst Pharmaceuticals drugs. So with that being said, let's take a look at the other revenue segments they have. Like we said, Agamree accounts for 100 to 110 million, while compared to Firdapse, which is the main driver of this company, 355 to 360 million dollars in revenue. Also, the Fycompa, which is for the epilepsy, 90 million to 95 million for 2025. So they only have 3 drugs right now, but I honestly think that with the Firdapse, if more and more people start to get diagnosed, this could really help drive their revenue and earnings a lot. So with that being said, let's go over to MarketDash.io. Taking a look at MarketDash.io for Catalyst Pharmaceuticals here, taking a look at the SWOT analysis, some strengths is the revenue growth at 43.6% year-over-year growth. So that's very fast. Also, robust financial position with 580 million in cash with no debt. Diversified product portfolio, they have 3 different product revenue streams, so that looks pretty decent. And their strategic market penetration, Agamree captured 45% of patients. That is also good. Some weaknesses, however, is that insider selling could be concerns over the leadership confidence. So I'll definitely be a bit careful with that, but I still think that this company still looks decent. Also, the risk management concerns could be an issue. Weak earnings performance. The company reports below EPS. That's not too big of a concern to me. And they're kind of concentrated with these 3 products. They're not at least concentrated in just one, but at least they do have some diversification, but it's still only 3 products. So if one goes away or one doesn't do well, then the company is not going to be looking good for the future. Taking a look at the overview of Catalyst Pharmaceuticals here, like we said, $2.5 billion market cap, P ratio of about 12. So this is also a very low price to earnings ratio for this company. Also, we have the free cash flow yield very high at near 9%. The higher the free cash flow yield, the better. The average company trades in the low single digits, so that is very good. Also, the net cash, like we said, $650 million in net cash. Most of these small cap stocks seem to have a lot of cash compared to their market cap, and I like that because basically you're paying for that cash too when you're buying this company. So you're technically getting a decent return already since they have a lot of net cash and no debt basically. So with the no debt, it's very unlikely for these companies to go bankrupt. Taking a look at the 7-step stock analysis, we get 6 out of the 7 key metrics here. As we can see, the only thing that's an X is the shares are increasing. This is the only thing I don't love about this company at 5%. So with the intrinsic value calculations here, we saw the revenue growth is growing insanely fast at 40% or so. So I'm going to be a little bit conservative here. Let's say there's not as many people need these drugs since they're rare conditions, but potentially we could see 10% bearish, 20% base, 30% bullish. For the bullish case, I'm going to put 30% just because potentially 30%, because say these people are potentially have this disease that aren't diagnosed could potentially get this treatment in the future. And with the estimates of about 3,600 people that have the disease, but only 400 are being treated and actually are known to have it. If it comes out that those people are actually found out that they do have it, this will really help the company. Now for the future profit margin, their profit margin is at 37% right now. So let's just do 30, 35, and 40 just to be on the safe side. We're going to put a large range of numbers because this is a biopharmaceutical company. They can have a lot of fluctuation with their business. Now for the future P ratio, growing at 10%, let's just put a 20 P ratio, let's put a 30 and then a 40 here. Now for the shares outstanding, I think they're going to increase at about 6, let's do 6% or 7, let's do 7%. Base case, let's do 5% and then bullish case 3%. And if we calculate the intrinsic values here, we get huge returns with this company. An annual return of 35.5% on the base case. So this looks a lot better than the first company of Phototronics. But just be careful because this company is in very niche autoimmune diseases. So there's not going to be a lot of patients for this company. This company is not going to be able to get to a huge market cap. I would say max maybe 10 to 20 billion in the next 10 years, but it's at 2 billion right now, so that is a 10x gain. So I think it's definitely possible, especially if they can start to diversify even more. Now the final company that I'm gonna be looking at, this is gonna be called dLocal, and dLocal, if you've never heard of it, is a cross cross-border payment platform to connect global enterprise merchants with consumers in emerging markets. If we go and take a look at the stock price, in the past 5 years since it became public, the stock's down 55%. And this company is actually in Uruguay, so this is a financial technology company. And this company, if we go back over to these slides, like we said, is mainly connecting between borders for payments. So that's basically what they do. And looking at what they do, they have a major global companies like Amazon, Microsoft, Uber, and Google to accept and send payments in countries. So this company is dealing with a lot of large companies, which could be good for the future. Transaction processing fees is where they make most of their money, where they just charge about a 2.5 to 4% fee, as we see here, for the business between these cross-border payment platforms. Also, foreign exchange spread. With the foreign exchange, they actually make a slight percentage on the exchange rate when converting. So that's also another way. Taking a look here at the notable clients, like I said, Amazon, Wix, GoDaddy, Microsoft, Google, Spotify, Meta, Sony, HubSpot, Uber. They have a lot of big name companies as their main clients. So this is definitely interesting. So if they're willing to use this company, dLocal, I think other companies will continue to be willing to use them. And these companies, all of them look like great companies to grow. And if they grow with them and the volume of transactions grow, then this company, dLocal, will also grow with them, as we can see here. Now, going to the SWOT analysis here, we have strengths with emerging markets dominance and cross-border payment leadership. The company's cross-border payment volume surged 76%. So this company is really surging. They also have diversified revenue streams with Africa and Asia 25% and Latin America 75%. This could be huge for this company, especially if Africa starts to become a much more developed continent, because as of right now, obviously it's not that developed. It's one of the least developed continents, but if it continues to grow, which I think Africa could be the next place that really continues to grow, this will really help this company. However, weaknesses is margin compression, emerging market risks, also geographic concentration, and the only thing I also don't really like about this company is that there's a lot of other companies that do this, so they don't have a huge moat, but at least they're already integrated with a lot of big companies, so that could be seen as a positive. So if we go over to my website, let's type in dLocal here and let's analyze the stock. If we go over to the overview here, taking a look here, the market cap, $4.46 billion market cap. The free cash flow is very low, so that could either mean it's just a very high valuation or they don't have free cash flow really right now, which could make sense. If we go over, take a look at the free cash flow, let's scroll down here. Yeah, the free cash flow actually went negative, so that could be a worry. That could be something to look into, and the net income actually did decrease in the past year. So that's interesting. Take a look at the 7-step stock analysis. We get almost all of the key metrics besides the debt to free cash flow, which makes sense because the free cash flow was near negative last year and became negative this year. So that does make sense why it's so low. Everything else looks very good. The growth rates look very good. Everything looks very good. The only thing I'm a little bit concerned about is the profit margins decreasing that fast, because if we go over to the profit margins continue to decrease over time. That's a bit of a red flag to me, and I don't really like that. But with the intrinsic value calculator, I think these are fair growth numbers for this company. Once again, they're growing at over 40% right now. I think this company is due for good growth. Let's do bear case profit margin. Let's do 15. Let's do base case 20 and then bullish case 25. I think they can start to increase this profit margin higher as more and more companies start to use them and as more transactions happen cross-border. Now for the future P ratio, I think we can leave this here. And then for the shares outstanding, let's see how much they're buying back. They're actually buying back 1% each year. So that's actually pretty interesting. So let's just do bear case 0%, base case, let's say 1%, bullish case, they buy back 2%. With that being said, calculate the intrinsic values. We can get an annual return of 25% in the base case. So if you think they can grow 20%, I think this is a good company to buy. And thank you guys for watching this video on 3 small cap stocks that I believe can 10x. I think these last 2 companies definitely look the best. Phototronics does look interesting, but the growth rates are a little slow for me. But these 2 companies here with Catalyst Pharmaceuticals and dLocal definitely look interesting. Me personally, am I going to be buying right now? No, just because I need to do more research on these companies to see if these assumptions are actually worth it. So thank you guys for watching. Please subscribe. Let's get to 5,000 subscribers by the end of the year. Also, if you want to go check out the Patreon to get access to this website, click right here. year, 7-day free trial, and only $8 per month after that. And thank you guys for watching. See ya.